what is the idea of a share? How is it different compared to equity? Please understand. Generally, equity is represented in the form of percentage ownership. Generally, equity is represented in the form of percentage ownership. 10% equity, 100% equity, 51% equity, right? 8% equity, etc., etc. Whereas on the other side, shares represent units of ownership. I'll give you example. Please have patience. Shares represent units of ownership. So what do you mean by units of ownership? Look at the last part of the slide. I've given an example. Let's say there is a company ABC, and this company, let's say, has issued total 5 lakh shares, right? Totally they have issued 5 lakh shares. Now, can I say all these 5 lakh shares are individual units of ownership? Think of it, right? The company ABC has issued 5 lakh shares, which means they represent individual units of ownership. But out of 5 lakh, imagine you purchased 20,000 shares. Out of all the 5 lakh, imagine you purchased 20,000 shares. Now, can I say 20,000 out of 5 lakh represent 4% ownership in a company? Any difficulty in the calculation? If you are having a doubt, sir, how come it is 4%? Use the calculator. 20,000 divided by 5 lakh into 100%. Right? So basically, argument is simple here. Shares represent individual units of ownership, whereas equity represents percentage ownership. How much is the percentage ownership in a company? Right? Now, going forward, I'll tell you what types of shares are there. I'll tell you, please don't worry. By purchasing them, investor will get ownership in a company. These are tradable in the market, that is in the stock market. And for example, if you purchase Adani shares, can you sell those shares in the stock market? Yes. If you purchase a Paytm shares, right, that is 197, can you sell them in the stock market? Again, yes. Zomato, yes, these are tradable. Shares are usually measured in terms of numbers, whereas equity is measured in terms of percentage. Done. Now, come back to this idea. Come back to this concept. Please tell me, do you remember the idea of a primary market and secondary market? Let me know. Please let me know that you are revising, right? That is how I will come to know that you people are revising. What is primary market? What is secondary market? Primary market is the market where new issue of instruments will happen. I'll repeat it. Please let me know whether you remember this or not. Primary market is a market where the new instruments are issued for the first time. Whereas a secondary market is a market where the instruments which are already issued are traded. All of you are okay with the argument of primary and secondary? Let me know. All of you are okay with the idea of a primary and secondary? Primary means the instruments are issued for the first time. New instruments will be issued. Whereas a secondary means the instruments which are already there, these will be traded in the market. For example, I'm an individual. I repeat, I'm an individual. We have done this circus multiple times now. I'm an individual. I have purchased the shares of Adani company. Now I will sell it to you. Can I say this is a secondary market? Simple. Can I say this is a secondary market? Second example, I am an individual. I'll purchase this share from Adani company when they are issuing it for the first time. Can I call it as a primary market? Very simple. Do not complicate it. Very, very simple. Okay. Primary instruments, new instruments are issued for the first time. Whereas a secondary instruments which are already issued will be traded. Now come to the point here. Right. In case of the idea of a primary and secondary, there are two terms, IPO and FPO. What is the long form of IPO and FPO? Let me show it to you. IPO basically stands for initial public offering and FPO stands for follow-on public offering. Now, what is the initial public offering? Imagine a company is there. I repeat, imagine a company is there, which is owned by 3 friends, right? Let's say 3 of you joined together, you started a company. Now, this company is performing very well. You have raised a lot of funds from the investors. Now, you want more funds. You want to expand operations. You want to purchase some other company, etc., etc. For multiple reasons, you want more money. In such cases, rather than you owning the company, now you will sell the ownership of company to the public. Very simple idea. Rather than you 3 having the ownership of the company, you will sell the ownership of the company to the public. Now, when you sell the ownership of the company to the public, can I call this as going public? Let me know. When you do this, that is, you sell the ownership of the company to the public, can I say you are going public now? Any problem in understanding this term? Please do let me know. You are going public, which means until now, you three were the owners. Now the ownership can be purchased even by investors, such as you, such as me, such as banks, such as other institutions in the market. So whenever you do this for the first time, that is when you sell the shares to the public for the first time, it is called as initial public offering. Any problem here? Whenever you sell the shares, that is the company will sell the shares for the first time ever to the public. This is called as initial public offering. And whenever any company goes for initial public offering, we say company is going public, or else we will also simply say the company is now a listed company. Listed company means what? The company's shares are there in the stock market. You can purchase the shares from the stock market. You can sell the shares in the stock market. This is called as a listed company. For example, please do let me know. Is Infosys a listed company? I hope you understand. Is Infosys a listed company? Is Zomato a listed company? Right? Is right? Let's say Paytm a listed company. Yes, all these are listed companies. Right? So whenever companies will issue shares for the first time ever to the public, this is called as a listed company. Now the shares can be purchased, they can be sold. In simple terms, we will say shares can be traded in the stock market. Now, imagine there is a company ABC. It has conducted IPO in 2020. Can I call this as basically a listed company now? Yes. Now the same company, which is a listed company, I repeat, same company, that is ABC, which is a listed company, can again issue shares in 2030. They can do that. They can again issue shares in 2030. They can again issue shares in 2045. But please tell me, a company which has already conducted IPO, can I say 2030 again it is going for IPO? Does it make sense to you? A company which has already conducted IPO, can we say again in 2030 it is going for IPO? No. Again in 2045 IPO? No. So please remember, once IPO is done, after that, any number of times a company will again issue new shares to the market. It is called as FPO. Right? Once IPO is done, after that, if the company will issue new shares again in the market, it is called as FPO, follow-on public offering. Right? A listed company will issue shares again in the market, which is called as an FPO. So any problem with the term IPO and FPO? Right? Can we connect it to current affairs? Have you heard of Adani Company? Let me check how many of you have read the newspapers in the last 1 year. Adani Company. Right? Please tell me, was the Adani Company involved in IPO or FPO? Let me see. Right? The Hindenburg report. The issue of Hindenburg report and Adani Company. Was the Adani Company going for an IPO or FPO? My dear, Adani Company was going for an FPO then. Check it. Please check it very carefully. Adani Company was actually going for an FPO, follow-on public offering. Adani is already a listed company. It is already a listed company, right? Which means the shares of the company are already traded. Don't you think? Again, understand this. Many of you will say, sir, right? How do I know it is an IPO or FPO? Right? I don't remember what happened. My dear, please tell me, once the report of Hindenburg was published, what happened to the share prices of Adani Company? What happened to the share price of Adani Company? Share prices took a hit. They crashed, they dropped, which means the company is already listed. Let me know, does it make sense or not? The share prices, that is the market prices of the Adani Company, share prices took a hit. What does it mean? It simply means it is already listed, which means IPO is already done. So now they cannot do IPO. They will have to go for FPO. Right? All of you okay with that? Right? So even in UPSC, just try to connect the dots like this. Many of the times by connecting the dots, you'll be getting the answer. Now, whenever you talk about shares, traditionally there are two types of shares. Whenever you talk about shares, so there are traditionally two types of shares. One is called as an equity share. Second one is a preference share. Understand the point very carefully here. One is equity, another one is preference. Now, equity shareholders are basically the owners of a company. These are stakeholders, equity holders in a company. And the dividend that is given to the equity shareholders, the dividend that is given to the equity shareholders, there is no fixed amount of dividend. There is no fixed amount of dividend. For example, imagine you purchase this equity share of Adani company. Okay. You purchase the equity share of this Adani company based on the profits, based on how much profits they earned. In 1 year, you might get 3 rupee dividend per share. In another year, you might get 5 rupee dividend per share. In third year, you might earn only 1 rupee per dividend per share, which means there is no fixed amount of dividend that is given to you. If the company makes profit, the amount of dividend will vary from 1 year to the next year. But very important, equity shareholders will have a voting right. Remember this, right? The equity shareholders have voting right. Voting right means what? Imagine the company wants to acquire one more company. Imagine the company wants to change the payment for the CEO. Imagine the company wants to expand its operations. Don't you think they should take the approval of owners of the company? Think of it. Please think of it. In making certain decisions, don't you think the company, before they take the decision, should take approvals of the owner? Now, who is the owner here? Who is the owner? Can I say shareholders are the owners of the company? Any problem connecting the dots? Please do let me know. Any problem? All I'm saying is there are certain decisions which the company will take only after taking the approval of the shareholders. Now that is approval. That is nothing but the concept of voting. The equity shareholders have a voting right. They can participate. They will vote. They will either say this we will not approve, this we will approve. This is a concept of voting right. Now come to the preference shareholders. Right? Come to the preference shareholders. Now what is this? Preference shareholders. These are hybrid instruments. These are hybrid instruments. Right? What do you mean by hybrid instrument? Think of this very carefully. I will write the term bond here. In case of a bond, you will get guaranteed fixed amount of coupon. I hope you understand this. In case of a bond, you will get guaranteed a fixed amount of coupon. That is, what do you mean by this, sir? Imagine the bond value is 100 rupee. It is a 6%, right? It is a 6% coupon rate, which means annually you will get how much? Fixed 6 rupee coupon. Any problem with this? Right? On the other side, if you are a shareholder, that is equity shareholder, you have ownership in a company. You have ownership in a company. Now, please have a look at preference shares. Look at preference shares. These are also types of shares only. You can purchase, have ownership. But please understand this. In case of preference share, they will carry fixed amount of dividend. They will carry fixed amount of dividend. Fixed means what? Annually, let's say 4 rupee coupon. Annually, 4 rupee coupon. So, and from 1 year to next year, out of profit, how much coupon you will get? How much interest or how much dividend you will get? You will keep on getting 4 rupee every year. Every year you will keep on getting 4 rupee. Whereas in case of equity, there is no guarantee how much dividend you will get. You might get 3, you might get 4, you might get 5, you might get 8 also. Now, please have a look at it. Can I say based on this, preference shares have certain features of bond, have certain features of shares? Let me know. Based on this, can I say they have certain features of bond, have certain features of shares? Can I call this as a hybrid then? Hybrid means what? Mixture. Hybrid is nothing but mixture. Can I call this as a hybrid instrument? Answer is yes. That's the reason preference shares are called as hybrid instruments. Are preferred over equity shareholders whenever the dividend has to be distributed. And because there is a fixed amount of a dividend that is given to you, preference shareholders will not have any kind of voting right. Preference shareholders will not have any kind of voting right. So these are the two types of shares here. One is equity, second one is preference. Now let me ask you a very simple question. Are cooperative banks are they allowed to issue these instruments in India now? Let me know. Right? Are cooperative banks in India allowed to issue these kinds of instrument? Answer is yes. Right? Answer is yes. After 2020, these are allowed to issue. Okay? Can we go forward? If there is any losses in preference share, my dear, please tell me whether it is a preference or equity. Simple question. Whether it is a preference or equity, do you think shareholders will get money, that is dividend, if the company incurs a loss? Think of it, no? Whether this is equity or preference doesn't matter. I repeat, whether this is equity or preference doesn't matter. If the company incurs a loss, do you think, right, any one of them will get profits? No, they will not get profit. My dear, please understand. Why? Shares means what? Ownership. Share is nothing but ownership. If the company incurs a loss, how can owners get returns? Think of it, no? If the company incurs a loss, how can the owners get returns? They will not get returns. So again, do not complicate it. Do not complicate the issue. These are owners. Only difference is one set of owners will have voting right, but no guaranteed dividend. How much they will get, there is no guarantee. Another set of shareholders, they will not have voting right, but guaranteed dividend. Fixed amount of dividend every year. But dividend has to come from profit. Very simple. Right? Dividend has to come from profit. If the company doesn't earn profit, no way, you will not be getting anything. Okay? Anything else? Anything else? I am a shareholder of so many companies, but no one is taking my approval. My dear, please let me know. If you're a shareholder, are you called for annual general meeting? Please check your mail. Please check your correspondence. You will come to know. You do not check it, right? I know many of you are shareholders in companies. I know. Will you get a correspondence regarding annual general meeting? What do you think happens in an annual general meeting? What do you think happens in annual general meeting? They will ask you for voting. Even without going also, you can appoint someone to vote in your favor. Even if they will not ask you to come physically, they will send mail also, ask you to vote. So I hope you understand, right? Voting is a very, very important part and parcel of equity shareholders. Only thing is that, you should be, right, proactive, you should be participating, right? Only then you'll understand, okay, sir, voting right is also there. Okay, done. These are the types of shares. These are the types of shares, right? This is the idea for IPO, FPO. Now, right, primary market and secondary market. Company issues the shares to the public for the first time, which means it is going public, right? Initial public offering and a FPO, right? It is done in the primary market. Once IPO is done, the shares of these companies will be available for trading in the stock market, and we'll also say the company is listed now. Okay. Secondary market, best example for secondary market is a BSE and NSE. Best example is BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. So the companies, right, which are listed in BSE, their stocks are traded in BSE. Those which are listed in NSE, their shares or stocks are traded in the NSE. So BSE as well as NSE, very, very important, right? Let's say stock markets in India. We also have regional stock markets. Regional are not important, right? Regional not important, but the national level, at the national level, two important stock markets are there. One is a Bombay Stock Exchange and the second one is National Stock Exchange. Okay, done. So this is basically the idea of a primary and secondary market, right? IPO, FPO, types of shares, what is a share, what is equity, etc., etc. Can we go forward now? Let me know. What can we go forward? Sir, what is Bank Nifty, Nifty 50? Please understand. Whenever you talk about stock market, right, there is a concept of index. There's a concept of index. Index represents what? It basically represents what is happening to market capitalization. Now, don't enter into all of these details. For GS paper, I don't think so. You will have to learn about Sensex, right? Let's say Nifty, how many companies are there, right? Which 30 companies here, which 50 companies here, don't worry. But whenever you talk about index, for BSE, Bombay Stock Exchange, the index is called as Sensex. Have you heard of this? Let me know. Those people who are reading newspaper, have you heard of this? Sensex. And in case of NSE, this is called as a Nifty. This is called as a Nifty. What basically idea is, in case of BSE, we'll measure what is happening to market capitalization of 30 companies. And that measurement is called as a Sensex. Whereas in case of NSE, rather than 30 companies, we'll take 50 companies. And we'll measure what is happening to market capitalization of 50 companies. That is the reason this is called as a Nifty. That is basically the concept of Nifty. Okay, done. Now don't enter into calculation. Some of you are worried about calculation. I will not enter into calculation. That is not required for UPSC. Right? How Nifty 50 is calculated, how Nifty Junior is calculated, not needed. It is GS paper. It is not a stock market class. Right? There is a method of calculation, not at all needed for UPSC. Okay. Can we go forward now? Right? Let's go forward. Concept of P notes. Now, what is this idea of a P note? P note basically is nothing but a participatory note. P note means a participatory note. Now, what is this participatory note? Let me give you a very simple example. Let me give a very, very simple example. You will come across a term called as foreign institutional investor. Let me start with that idea. Now, there is a term called as foreign portfolio investors. There is a term called as foreign portfolio investors. Right? In short, you will come across right the term called as EFPI, foreign portfolio investor. Now, think of this. Foreign means, can I say any non-resident investor? Point number one. Please do let me know. When you say foreign, can I say any non-resident investor? Non-resident. Non-resident means the one, right, which is not residing in India, which is not there in India, outside. For example, what if an individual investor will invest in India's stock market? Possible? Of course, yes. Right? Just like you are allowed to invest in USA stock market. By the way, I hope you know this. If not, listen to me now. Can you invest in USA stock market? Answer is yes. Very simple. Can you invest in the USA stock market? Purchase a Tesla shares? Of course, why not? Can you invest in the USA stock market? Purchase Apple shares? Of course, yes. You are allowed to do that. Now, just like you are allowed to invest in the USA stock market, can I also say a USA investor, individual investor, might invest in India's stock market? Why not? Right? I hope you understand this. So, individual investors, they are allowed to invest. What about mutual fund companies? Foreign mutual fund companies? Of course, yes, they are also allowed to invest. What about insurance companies? Of course, yes, they are also allowed to invest in India. Now, understand the difference here. All of these examples that I've given, all of them collectively are referred to as EFPIs. I'll repeat it. All of them collectively are referred to as EFPIs. But please tell me, how many of them are institutions? Let me know. All of these are collected. Again, these are just examples. There are many more types of investors. But all of these are, right, foreign portfolio investors. All of them are FPIs. But out of these, right, don't you think second and third are financial institutions? Any problem here? Second and third are financial institutions. Now, please tell me, is the term foreign institutional investor okay with all of you? Let me know. Is the term foreign institutional investor okay with all of you? Right? Now, point number one. Let me go to point number two. The foreign institutional investor, whenever they want to invest in India, first they will have to be registered with SEBI, Securities Exchange Board of India. SEBI is the market regulator. SEBI is the market regulator. So if you want to invest in India, you will have to be registered with SEBI. Now, the point number two. Let me go to point number three. Imagine there is a foreign investor. Here is the investor. Okay, imagine there is a foreign investor who wants to invest in the India's stock market. But if they want to invest, first they will have to get the registration from SEBI done. They will have to go to SEBI, get right registration done. Only then they will be allowed to invest in India's stock market. Now, what if I say you are the foreign investor, you will go to SEBI, you will apply for registration, it will take 2 months. It will take 3 months. Right? Or you have given lot of documents, SEBI will ask for more documents, more proof of documents from your side, which will again mean what? It will take more time period for you to invest with SEBI, to get registered with SEBI. Now, please tell me, if you do not want to do all of this, if you do not want to wait for so much longer, don't you think you will not be able to invest in Indian market if there is no other option available apart from this? Yes or no? If this is the only method, that you will have to go through SEBI, right? Wait for 2 months, wait for 3 months, get the registration done. Only then you will be allowed to invest in India's market. For many investors, they might simply say, this is very lengthy process for me. This is a very cumbersome process, right? So what is the point of waiting for 2 months? I will not invest in India. For such a type of investors, there is one more route available. There is one more option available, which is called as participatory note. For example, let's imagine this. This is a foreign institutional investor, right, from USA. Now, this foreign institutional investor will issue instrument. I repeat, will issue instrument. Imagine you are the investor. You are X. You are there in USA, right? I am a foreign institutional investor. I will issue this piece of paper to you. I'll collect your money and I will invest this money in Indian stock market. Very simple idea. Very, very simple idea. I'll repeat it again. You are a foreign investor, let's say USA. I am also a foreign institution. What I will do is, I will issue this piece of paper to you. By the way, this is participatory note. I will issue this piece of paper to you, collect your money, and I will use this money to invest in India. And this piece of paper that you purchase, that is called as participatory note. Can you see the picture now? Is the picture okay with all of you? Is the picture okay with all of you? Now tell me, can I say participatory note is an offshore instrument? Point number one. Can I say participatory note is an overseas offshore instrument? Anybody has a problem with this? Second point. Can I say if you want to invest in India now, right? You are a foreign investor, mind you. If you want to invest in India, you will purchase participatory note and through that you will invest in India. Can I say this? Right? If you're a foreign investor, now one of the options that is available to you to invest in India is through participatory note. You will purchase participatory note and that money will be invested in India. Point number two. Point number three. There's a term called as a derivative. There is a term called as derivative. Now, very simple concept. Do not complicate it. Do not enter into derivative market. There is a very large market within India's financial market called as a derivative market. Very complicated. Do not enter into all of it. What is a derivative? Let me give it to you in a very simple way. Derivatives are those instruments. I repeat, derivatives are those instruments which will derive their value from an underlying asset. I'll give you the example. Please have patience. Please have patience. I'll repeat it again. Derivatives are those instruments which will derive their value from an underlying asset. Meaning what? Meaning what? Let's go a very simple example. Imagine I will issue this piece of paper to you. I'll call this as a derivative. But I will simply say the value of this piece of paper is equal to value of rice. Simple. Right? I'll repeat it again. I will issue this particular piece of paper to you, but I'll say that the value of this piece of paper is equivalent to whatever is the market price of the rice. Now, please tell me, can I say this piece of paper, which is an instrument, is deriving the value from underlying asset, that is rice? All of you okay with this? Right? This piece of paper is deriving the value from an underlying asset. What is the underlying asset? Piece of paper. The rice here, the example that I gave, this is called as commodity futures. This is in simple terms called as commodity futures, right? That is a commodity is used, right, as an underlying asset, and this derivative will derive its value, from the price of commodities in the future. So gold, right? Gold can be used as a commodity. Agriculture commodities are used here. That's the reason you do not enter into derivative market. Derivative market is very complicated. For GS paper 3, absolutely of no use for you. But I hope you understand what you mean by derivative now. I hope you understand. What do you mean by derivative? I hope you have understood this. Now, let me go to the next point. Now. What is the use of all of this? Imagine I will collect the money from you by issuing a P note. I will collect the money from you. I will use it to purchase Adani's shares. Think of it. I will issue the P note to you. I will collect the money. I will use it to purchase the shares of Adani company. Now, can I simply say your instrument is going to derive value from the market price of Adani company shares? Yes or no? I hope you understand. There is one student says, if UPSC is not going to ask, why are you telling me all of this? My dear, I am telling you all of this because of this. Right? Where is that term? Look at this. Right? I'm taking so much of pain and trying to convince you people because of this. Look at the statement of P notes. Please look at the statement for P notes. P notes are among the group of investments which are considered to be offshore. Anybody has a problem why this is called as offshore? Second, anybody has a problem why it is called as a derivative instrument? Right, tell me. Right, anybody has a problem why it is called as offshore? Anybody has a problem why it is called as a derivative instrument? My dear, this is the precise reason. This is a precise reason why I'm discussing. Right? There are many students who will keep on saying, if UPSC will not ask, why are you right simply disturbing my mind? Don't tell it then. My dear, I'm explaining only for a simple reason. Right? UPSC might ask you, is a P note type of a derivative instrument? Right? I hope you can understand this. They will ask you, is it belonging to type of a derivative instrument? Answer is yes. I hope you understand this. Okay. Done. So participatory notes also are referred as P notes. And more important, in this example, let me know. In this example, can I say by purchasing P note, there is no requirement for you to get registered with SEBI? Let me know. Right? In this example, right? Look at the example. By purchasing a P note, can I say there is no requirement for you to get registered with SEBI to invest in Indian market? Answer is yes. So these are certain important points regarding participatory notes. Please be very careful. These are financial instruments used by the foreign investors to invest in Indian securities market. The foreign investors need not register with the SEBI, right, for investing in stock market. Right? These instruments are very famously referred to as participatory note or P note. Next concept, credit rating. Next idea is credit rating. Very simple concept. Very, very simple. What is credit rating? Credit rating, just a second. Credit rating refers to the credit capacity or ability or the willingness of a borrower. Very simple idea. Do not complicate it. What is a credit rating? Credit rating represents the credit worthiness. Credit worthiness means what? What is the willingness of the borrower to repay the money? Right? For individuals, we have CIBIL score. For government, for companies, we have concept of credit rating. Now, credit rating is provided by credit rating agencies. The global 3 credit rating agencies, very, very important. The global 3 credit rating agencies are these 3. One is S&P, Standard and Poor. Second one is Moody's. Third one is Fitch. All the 3 are very important. In fact, very often these are there in the current affairs. For example, can I say Fitch credit rating agency was very recently in the newspaper. Think of it. Fitch credit rating agency was very recently in the newspaper. In fact, I've asked you to read today's Hindu newspaper. Again, it is mentioned in that. Now, why these 3 rating agencies are very important? Most of the rating work in the global market is handled by these 3. All these 3 are American companies. All of them are American companies only. More than 90% of the global credit rating is controlled by these 3 agencies only. Done? Right? Now, next point, last point. After this, we'll stop. Read the article today after this. Whenever you talk about credit rating, generally you represent the credit rating either in the form of only alphabet or in the form of combination of alphabet and number. For example, Fitch will always provide a credit rating in the form of alphabets, and Moody's will provide in the form of combination of alphabet and number. And right, even S&P provides only in the form of alphabet. Now, what is the importance of these alphabets? Right, combinations you can say AAA, A1, A2, right, a triple B. These are alphabet combinations. So what is the importance of these alphabets? Please remember this. If you keep on going downward in the table, we'll simply say credit rating is lower. Any problem here? I'll repeat the statement. If you keep on going downward in the table, right, meaning is credit rating becomes lower. Very simple idea. For example, do you remember your high school or even, right, let's say kindergarten or let's say your lower level educations, that is, let's say first standard, second standard. Do you remember grades? Right, a person who has scored highest, they will be given a grade of A++. Right, somebody who has scored lesser will be given a grade of B. Right, somebody will be given a grade of C. Apply the same logic here. Apply same logic. Argument is the lower, right, the grade will be, that is basically if you move away from B, if you go towards a B, C, D, what does it mean? Your performance is poor. Right, your performance is actually poor. That's a basic idea. Apply the same logic here. The highest credit rating is a AAA. Highest credit rating is a AAA. And as you keep on moving downwards, credit rating will keep on decreasing. Right? And now tell me, if the credit rating is decreasing, don't you think by investing in such instruments, you're taking higher risk? Last point for the day. We'll continue tomorrow after this. I'll repeat the statement. As you keep on moving downward like this, are you not taking higher risk? Yes. If you're taking higher risk, what should be the coupon rate? What should be the interest that you're going to demand? Interest rate will start increasing. Please remember this. Please remember. Now, read the article today. If not, don't worry. Tomorrow we will discuss more about credit rating. Automatically, you'll start understanding these kind of concepts. Okay, done. So let me take a pause now. Let me stop the discussion today here. Tomorrow we'll continue. Now, if there is any concern regarding what I've discussed, please do let me know. Sir, if they default, then would it not result in sovereign credit rating degradation as a disadvantage? Of course, yes. I'll discuss more about this tomorrow. Don't worry. Okay. Sir, we say that issue at discount. Okay, already I've addressed it. Descriptive questions will take it up tomorrow. Don't worry. P notes are not understood. P note purchasing not understood. My dear, I am, let's say, an institution, financial institution. I will give you this particular piece of paper. This is called as a P note. I will take money from you. You are not registered. I am registered with SEBI. I will sell this to you, collect money. I will use the money to invest in India. This is a participating note. Okay. What is a derivative? What is a derivative in the concept of P note? I have given this P note, sold it to you, collected money, and I will purchase Adani shares. Shares of Adani company with that money. Now, please tell me, will the market price of Adani shares keep on fluctuating? Let me know. Will the market price keep on fluctuating for Adani company? Of course, yes. And because I've taken money from you to invest in Adani shares, can I say the value of P note? Because, the money I've used to purchase Adani shares, value of P note will also keep on fluctuating. So P note is deriving its value from the investment. That's a basic idea. Hybrid instrument, preference shares, there is a fixed amount of dividend. Fixed amount of dividend. Just like you get a fixed coupon rate in case of bond. And on the other side, you are a shareholder, meaning, you are a owner. So the preference share will have a feature of a bond, a feature of a share, hence a hybrid. FII, one of the option for money laundering, and there is always a concern. That foreign investments, can be used, to basically convert black money into white money. Money laundering is a conversion of black money into white money. Okay. Who decide to invest in P note? Foreign investors. Sorry, FDI will increase in India. Okay, when we discuss FDI, we'll take up this question. Don't worry. ODI, please explain again. What is ODI? I don't know, Baba. Green bond, not understood. Green bond basically means an institution, government, etc. They will issue bond, collect money, invest in only environment-friendly projects. That's it. Okay. Sir, are they allowed to invest via P notes always? Generally, huge amount of money is invested in India through P notes. Thousands of crores of rupees invested. Okay. Okay, so let me take a pause now. Let me stop the discussion. Tomorrow we'll start with the concept of credit rating from where we have left off. We'll start from there only. Okay, so take care. Have a great day. See you tomorrow sharp at 6 a.m.